Welcome to Talk Tickers, where we break down the earnings calls that actually matter. Today, we are diving deep into Howmet Aerospace's Q3 2025 results. Now, this was a really interesting one, a quarter that delivered a super strong beat, but, well, the market's initial reaction was perplexing, to say the least.
So, Howmet beat Wall Street's earnings expectations by 4 cents a share. But you know, that simple number, it really doesn't tell the whole story here. There's so much more going on under the surface, so let's break down exactly what happened.
All right, here's the game plan. We'll start with those headline numbers. Then we're going to dig inside the numbers to see what's really driving this performance. After that, we'll look at the company's guidance, dissect that weird market reaction, and then, of course, we'll wrap it all up with our final call on the stock.
Okay, first up, the headline beat. And let's be crystal clear, the results were unambiguously strong. I mean, this wasn't just a squeak-by beat, it was a really clear outperformance across all the key metrics that Wall Street cares about.
Just look at this table. This was what you'd call a comprehensive beat. Revenue came in at almost $2.1 billion. That's up a solid 14% from last year. But the real story, the one that got everyone talking, is on the bottom line. Adjusted earnings per share grew a remarkable 34% to 95 cents. That is some serious growth.
So the big question is, how'd they pull off numbers like that? Well, it really comes down to this powerful combination of 1, just fantastic operational execution, meeting 2, really strong long-term demand in their most important markets.
And you can see here, the main growth engine is still commercial aerospace. I mean, it makes up over half their revenue, and it was up 15%. But the number that really jumps off the page, a massive 38% jump in commercial aero spare parts sales. Wow. That just tells you how much those older planes are flying and how much maintenance they're sucking up.
And this slide, right here, this is the story of operating leverage in action. Check it out. Adjusted EBITDA margins expanded by a full 290 basis points. What's so impressive is that they did this while adding over 265 new people to staff up their new plants. That right there shows some serious efficiency.
All right, let's move on to guidance and their big growth plays. All of this strong performance really builds into management's forward look, which, let's just say, it signals some pretty aggressive confidence in their strategy. So not only did they raise their full year 2025 guidance across the board, they also gave us an early peek at 2026. And get this, they're targeting an impressive $9 billion in revenue. That's another 10% jump from an already really strong 2025. They are not slowing down.
But listen, this isn't just growth at any cost. No way. Management is playing this really smart. They've got this balanced, three-pronged strategy. First, they're aggressively investing in new capacity. Second, they're returning a ton of cash to shareholders. And third, they're shoring up the balance sheet. So much so that they even earned a credit upgrade from S&P. That's just smart business.
Now, during the Q&A session, CEO John Plant said something that really caught our attention. He highlighted this emerging catalyst, extraordinary, his word, for industrial gas turbines, or IGTs. And what's driving it? The explosive build-out of data centers, for AI and everything else. This is an absolutely crucial theme for the future.
Okay, so now we get to the core puzzle of this whole earnings event. Because despite the stellar results, the super strong guidance, and that emerging data center growth story, the stock's initial reaction was, well, surprisingly negative. Makes no sense, right?
So here's how it all played out. The stock initially popped right after the call, just like you'd expect. But then, it completely reversed course. It closed in the red on pretty heavy volume, only to then recover and rally strongly the very next day. A total head-scratcher.
So what's the crucial point here? It's this complete and total disconnect. You had this overwhelmingly positive fundamental story on one side, and on the other, you had this really weak intraday price action. To me, that suggests there was some initial confusion out there, or maybe just some heavy profit-taking before, cooler heads finally prevailed. Okay, so we've decoded the past. Now it's time to turn to the future. It's time for our definitive analysis and rating in a segment we like to call The Next Call. So, the key question for all you investors now is pretty simple, right? Was that rebound the real signal? And is there actually more upside from here as we start looking toward the next earnings report?
Well, we believe the momentum in those aerospace spares, plus that accelerating demand from the data center IGTs, provides a really powerful tailwind. Our view? We think Howmet is probably going to come in at the high end or maybe even slightly above its own Q4 guidance.
So based on their fantastic execution, those clear long-term tailwinds in both aerospace and data centers, and a really disciplined capital strategy, we are initiating coverage with an outperform rating.
So what's the trade idea? Well, our thesis is pretty simple. The market gets the aerospace strength, it's digested that. But we think it's still sleeping on the IGT data center narrative. We think that creates a multi-year opportunity. Now, for the more plausible pitch, if you really want a leveraged way to play this, you could consider long-dated call options to express that view that this IGT growth story is only in its first inning.
All right, that wraps up our deep dive into Howmet's quarter. And as always, remember, this analysis is for informational purposes only. This is not financial advice.